When one of America's biggest home builders lays out its strategy, it's not just a business plan. Nope, it's basically a weather forecast for the entire housing market. So today, we're going to dig into PulteGroup's latest numbers, unpack their playbook for 2026, and figure out what it all means for home buyers and really for the whole economy.
All right, first, a super quick refresh. PulteGroup is an absolute giant in the home building world. Chances are you've seen their communities. They've got brands like Syntex, which is geared toward first-time buyers, Del Webb for the active adult crowd, and, of course, Pulte Homes. How they're doing is a really great way to take the temperature of the U.S. housing sector.
And that brings us to the big question, right? In a market like today's, with interest rates all over the place and a lot of uncertainty, how does a company this big stay on top? Their playbook tells us a ton about what we should probably expect in the year ahead. Okay, let's start with the hard numbers. How did they actually wrap up 2025? The results from their fourth quarter, well, they give us our first really important clues.
So the Q4 results were what you'd call a classic split decision. On one hand, their profit per share, their earnings, didn't quite hit what Wall Street was hoping for. But on the other hand, the total cash they brought in, their revenue, was actually better than expected. So what does that tell us? It paints a picture of a company that's great at bringing in money, but is feeling the pressure on its profit margins for each and every sale. And if we zoom out and look at the whole year, the sheer scale of this company is just, wow. They pulled in $16.7 billion in home sale revenues in 2025. That is a massive number that really shows you just how much muscle they have in the market. And where did that revenue come from? From handing over the keys to almost 29,500 new homes last year. I mean, just think about that for a second. That's tens of thousands of families starting a new chapter in their lives. And that's all coming from just one company.
And here's the bottom line. Even with a really tricky market, they still cleared a massive $2.2 billion in pure profit. Net income is what's left after every single bill is paid. And to put that into perspective, this was one of the most profitable years in the company's entire 75-year history. That is a huge win, no matter how you slice it.
So how in the world do you pull off a year like that in a shaky market? Well, the answer isn't some brand new trick. It's actually a strategy they've been perfecting for over a decade: diversification. And this right here, this chart basically shows you their secret sauce. See, they don't just build homes for one type of buyer. Their business is really nicely balanced. You've got about 38% first-time buyers, 40% who are moving up to a bigger home, and then that 22% slice of active adults who are often retirees. It's a brilliant setup, because when one of those groups gets a little hesitant, another one can pick up the slack. And hey, don't just take my word for it. The CEO, Ryan Marshall, pointed directly to this. He basically said that while other buyers were hitting the brakes, the active adult segment was on fire. This wasn't just a small win. It was the strategic pillar that held up their entire year. It just proves you don't want to put all your eggs in one basket. Let's just focus on that number for a second. A 14% jump in signups from their active adult communities in the fourth quarter alone. That is powerful stuff, and it shows just how critical that diversification strategy was for getting through 2025. Okay, but it wasn't all sunshine and roses, right? To really get the full picture, we have to look at the challenges too. The company was pretty open about some pretty big headwinds that could cause problems down the road. And they flagged 3 big ones. First up, the cost of land. The actual ground they build on is getting way more expensive. They're predicting a steep 7 to 8% jump in lot costs for 2026, and that bites directly into their profits. Second, they're seeing demand soften up in some huge markets like Texas and parts of the West. And third, to keep sales moving in those tougher areas, they're having to offer more deals. So what exactly are buyer incentives? Well, think of them as the homebuilder's version of a big sale. It could be something simple, like a price cut, but what's really common these days is when the builder actually pays a fee to the lender to buy down the buyer's mortgage rate for a couple of years. It just makes that monthly payment a little easier to swallow. And these incentives are no small thing. They now account for almost 10% of a home's price. But here's the real kicker. That number is up from just 7.2% the year before. So the insight here is pretty clear. The cost of convincing a buyer to sign on the dotted line is going up, and it's going up fast. And that pressure is a huge reason for their next big move. Okay, so that's the landscape.
Amazing performance thanks to diversification, but they're facing rising costs and pricing pressure. So, what's the game plan for 2026? They've laid out a really clear three-part pivot. Number one, they're selling off their manufacturing business to double down on what they do best, buying land and building houses. Number two, that frees up a ton of cash and attention to focus on that core job. And number three, and this is the big one, folks, they're shifting their whole production strategy so that 60% of their sales will be build to order.
And here's the absolute best way to think about that shift. A spec home is like buying a suit off the rack. The builder makes it, hoping someone will like it enough to buy it. But a build-to-order home, that's like getting a custom-tailored suit. It's only made after a buyer has signed a contract. This isn't just about production. It's a way to de-risk the business in a volatile market. It prioritizes guaranteed profit over speculative volume. Pretty smart. And here's how that new strategy translates into their official forecast for 2026. They expect to close slightly fewer homes than they did in 2025, but at a higher average price. Now look at that gross margin line. That's basically their profit on each home before corporate costs. They expect that to hold strong, which is a huge vote of confidence in their new build-to-order plan. And finally, they are absolutely not pulling back on investment. They plan to spend a massive $5.4 billion on land. So all of this leaves us with one last really fascinating question. As a giant like PulteGroup shifts its focus to higher margin, custom homes and leans on its diverse customer base, are we seeing the blueprint for how the entire industry is going to try to win in 2026? It's a major strategic pivot, and you can bet it's one we'll be watching very, very closely.